when you're looking to build a dividend snowball to provide passive income that not only will meet your current expenses, but continue to grow that passive income over time at a pace that meets or beats inflation, you need to keep several factors in mind. First of all, you want to have a portfolio that has durable and defensive business models in it, that have solid balance sheets that can support those dividends over time and never have to choose between keeping the balance sheet solvent and paying out the dividend. But you also want investments that pay high enough yields that they have a reasonable chance of, in aggregate, meeting your current living expenses, while also still having enough retained cash flows and enough of an intrinsic growth potential in the business itself to be able to grow those dividends over time at a pace that meets or beats inflation. And so in trying to build a portfolio in aggregate that meets all these requirements, you need to keep two big things in mind to have proper balance. First of all, you need adequate diversification. And that's not just saying, oh, don't put all your eggs in one basket here, take 5, 10, 15, 20, 30, 50, 100 stocks or whatever the number may be that you settle on. That alone is not enough. It needs to be intelligent diversification. And by that I mean diversification across different sectors. Take, for example, Simon Property Group. Even though it had one of the best credit ratings in the REIT sector, had an attractive dividend that appeared to be well covered by cash flows. It had a high quality portfolio of Class A in the retail space with some good tenants. It looked really good as a business model. The COVID-19 outbreak occurred with all the lockdowns. Malls were vacated and they struggled tremendously during that period and had to cut their dividend quite deeply. Or Energy Transfer, which is an energy infrastructure company, had an investment grade credit rating, was covering its distribution by nearly 2 times. It had strong growth projects underway. It looked like it was going to be on pace to not only sustain, but even grow its distribution over time and deliver attractive returns to unit holders. But then with the COVID crash, with energy prices crashing, access to capital for hydrocarbon businesses being threatened by the increasing growth of the ESG investing movement at the time, Energy Transfer's management decided, with all this growth investment we have going on, we need to salvage our investment grade credit rating. So we're going to cut our distribution in half to retain extra capital to deleverage more quickly. So again, black swans like the COVID crash or something else like that could happen at any time and disrupt certain industries. And so that's why diversification across multiple industries is so important. At the same time as well, if you're looking for a certain yield that, maybe you want a really good yield to be able to meet current living expenses, but still have enough growth potential over time to be able to beat inflation. And maybe you care about getting a decent total return at the same time. Maybe you're like me and you believe in dividend investing, but you're young enough that you also want to be able to have a high rate of compounding of your wealth over time. When you do that, you also want to be balanced between a little bit riskier investments and more conservative investments. And by riskier investments, I don't mean swinging for the fences with some, company on the verge of bankruptcy that yields 25%, or a company that's virtually guaranteed to cut its dividend and you're just swinging for the fences hoping and praying. I'm not saying that. I'm simply saying there are the realty incomes of the world that are gold standard dividend stocks, Enterprise Products Partners, Enbridge, others like that fit in that category. And then there are other companies that maybe don't have quite the recognition. They still have they still meet those requirements with the solid balance sheet, the durable and defensive business model, the well covered and attractive dividend with the dividend growth potential. They still meet all those requirements, but they're not quite as established, not quite as well known as some of those gold standard blue chips, and therefore they can command a little bit more attractive valuations, a little bit higher yields, a little bit higher growth rates. Maybe they're younger, less mature business, so they have more of a growth runway. Opportunities like that. And so that's what I mean, balancing between the two, because I do think it's good to have some of those blue chip names that you know and trust, so you can sleep really well at night knowing those are a core of your portfolio. But if you supplement them with some of these other opportunities, you can potentially enhance your returns and enhance your yield. And then as the market fluctuates and certain opportunities become more opportunistic than others, you can do capital recycling to make sure your capital is always optimally deployed. And so those are the two aspects of diversification that I would encourage you to put into practice. And so in the rest of this video, I'm going to show an example portfolio, as some of my viewers have been requesting, of how I would implement these principles into building a dividend growth portfolio that yields around 8% on a weighted average basis, depending on exactly how you split the percentages. So if you like this kind of content, again, I would encourage you to please subscribe to my channel. I put out regular videos talking about individual stocks, portfolios like this, ETFs, CEFs, investing strategies, etc. Thank you very much. Okay, so how would I put this portfolio together? Well, simply, I would look for 4 main sectors that where I find the most attractive dividend machines, generally speaking, and then I would supplement that with 2 broadly diversified ETFs. So I'll talk about the ETFs first. So the first ETF would be the Schwab US Dividend Equity ETF. I think it's a great machine for dividends and dividend growth. Now, it only yields a little less than 4%, so that's only half of what I want with my 8% target rate, right? But it has a 10-year CAGR for its dividend per share growth of almost 11%. So it's a phenomenal dividend machine while still paying out a pretty solid dividend yield. So for that reason alone, I would want that in my portfolio. Another one I would like is the NASDAQ Equity Premium Income ETF from JP Morgan is JEPQ. Now, I'm not a huge fan of these covered call ETFs simply because they have a risk of NAV erosion over time, because as a covered call fund, they write covered calls on their underlying index, which in this case is the NASDAQ 100. And so during sharp market rallies, they don't participate fully in the upside, so they get left behind. Meanwhile, during crashes, they participate fully in the downside because the calls only cap upside, not the downside. And so if you have a market crash followed by a sharp market recovery, such as we had past year in April, or certainly during the COVID crash, and certainly in other past times in history. And this increasingly seems to be the case because of information flows are so much faster now, and you have all this algorithmic training that the market is very volatile in short periods of time. It can get completely left behind. So that's one reservation I have. But the big pro of a fund like JEPQ is that you get exposure to mega cap tech, because it has about 50% of its portfolio in mega cap technology stocks that you wouldn't already get in a fund like SCHD or some of these other higher yielding sectors. But because they use covered calls, then they're able to generate a higher yield, and thereby they're able to give you a good yield while still giving you that diversification by sector that I talked about at the beginning that's so important. So I think it's okay to have, say, maybe 10% of your portfolio allocated to a fund like JEPQ. The yield's phenomenal, it's double digit, it enhances your yield, balances nicely with SCHD to get you to that close to that 8% target. So I think JEPQ is worth holding. Now, what else would I do to round this out though? Well, what do SCHD and JEPQ lack in the way of exposure? Well, they lack exposure to midstream infrastructure. They don't have a lot of exposure to that. Business development companies, they have very little to no exposure to those. They have not enough exposure to real estate investment trusts, and they don't have exposure to CEFs. So I'm going to talk about a couple opportunities in each of those that I think could round out this portfolio nicely. So in the midstream infrastructure space, like I mentioned, there are some that are a little bit on the riskier spectrum, but they still meet those underlying requirements. I think Delek Logistics Partners is a good option. That's a ticker symbol DKL. And Western Midstream Partners, that's a ticker symbol WES. Those are both MLPs that issue K1, so keep that in mind. But they yield 9-10% each. Well-covered distributions that have been growing, should continue to grow at a rate that meets or beats inflation over time, and they have those long-duration contracted cash flows. So they meet all those requirements: durable and defensive business model, solid balance sheet, very attractive current yield, and that yield should grow at a rate that meets or beats inflation. Now you want to balance that with more conservative midstream, so whether that be Enterprise Products Partners, potentially even MPLX, Energy Transfer perhaps, Enbridge certainly qualifies, TC Energy certainly qualifies, or if you just want a diversified ETF that yields almost 8%, you can go with the Alerian MLP ETF. It's a solid option. I also like the Global X MLP ETF, depending on exactly how you want to shake those out. MLPA, which is the Global X MLP ETF, has a lower expense ratio, but the Alerian MLP ETF, AMLP, has a slightly higher yield, and some people like its underlying portfolio a bit better. So take your pick, or a little bit of both. I think those are fine to kind of round out that midstream exposure. Now, what about the BDC sector? Well, given that they invest in fairly risky underlying loans, because they're to middle market companies that typically don't have very strong balance sheets, and they can be somewhat economic sensitive, you want to invest in BDCs that have a lot of high in the capital stack exposure, have good underwriting teams, and not a ton of leverage. And so I don't really like to go out on the risk spectrum with BDCs. And so I would probably look at companies like Morgan Stanley Direct Lending that have over a 10% yield, almost all in first lien loans, respectable manager in Morgan Stanley, very low non-accruals, relatively low leverage, attractive valuation. So that's one I would like. I think Blackstone Secured Lending is fine. It's a little bit richly priced right now, but excellent external manager in Blackstone. Again, almost all senior secured first lien loans, attractive dividend yield of around 10%, low non-accrual, solid balance sheet. So again, I think BXSL has some merits to it if you're just wanting good income. And then of course you can always invest in an ETF like BIZD, and there are a few others out there that can give you broadly diversified exposure to BDCs if you prefer. Okay, but those alone also, combine with the MLPs and JEPQ to really boost your yield above 8% on those in aggregate. That offsets anything from SCHD. Okay, what about REITs? Well, REITs, you can take your pick. There are different options there if you want to go a little bit higher out in the risk spectrum, but again, looking for all those underlying checked things: that durable and defensive business model, the fully covered dividend, the attractive dividend, and the potential for dividend growth over time. Look at some underrated gems like Armada Hoffler Properties and Easterly Government Properties. Now, they both have recently cut their dividends, but if you look at the reasons, it's not because their businesses are declining or in distress. They're doing it because they want to shore up their balance sheet while still investing in growth opportunities. And with the high cost of capital currently, with interest rates so high, and their stock was trading really low to begin with, well below net asset value, they said, why would we issue shares to pursue these growth opportunities when we can just trim our dividend dividends a bit and retain the capital. I think over the long term, that's the prudent thing to do. Now, dividend investors may not like that, but I think they made the right decision. Now I think the dividends are in much more sustainable footing. Businesses and the balance sheets are on sustainable footing, and the yield's still really attractive because the market has sold off the stocks because of the dividend cut. So now you can get about an 8% yield from both of them, well covered with attractive long-term growth prospects. So I think those are good additions. Then if you want a diversified, fund with blue chips in it with a good proven management team, you can look at the Cohen and Steers fund, RQY. There are a couple others like it that they have that are also quality, but that gives you a nearly 8% yield as well. Monthly distributions. It has some of the big blue chips in there. Again, it's been proven to outperform the REIT space, including ETFs like VNQ from Vanguard over the long term. So I think that's a worthwhile holding as well to consider. Again, with a very stable dividend track record. Okay, finally, what other CEFs? Now, obviously, RQY is one of the CEFs, but there's another one I really like. It's the Reeves Utility Income Trust. It's UTG is the ticker symbol. It's a closed-end fund, has a very prudent amount of leverage, and it has a track record of not only sustaining but growing its dividend. In fact, it recently hiked its dividend, yields about 7%, and it is well managed, has outperformed the broader utility space over the long term and gives you exposure to some AI-related infrastructure opportunities. So there you have it. You have some attractive midstream opportunities like DKL, WES, and then say AMLP. And if you want to avoid the K1, just go with AMLP. You're going to get a little bit of everything, about a near 8% yield. Then in the BDC space, again, I like stocks like MSDL, and perhaps BXSL is fine. That gets you around a 10% yield from each of those, or even a little bit more in the case of MSDL. Then in the REIT space, you get 8% yields from the likes of DEA, AHH, and RQY. Again, if you want to just keep it simple, RQY is fine, but I think if you want some upside, AHH and DEA are worth considering. And then in the CEF space, you get UTG, and that gives you that exposure to infrastructure and utilities as well, which are also lacking to a great degree in SCHD and JEPQ. So that gives you a nice diversified, balanced portfolio of high-yielding opportunities that yield between 7 and 10%. That rounded out nicely with JEPQ's double-digit yield and SCHD's 4% yield, but strong dividend growth. And so when you put that all together, you get solid dividend growth and an 8% yield from a dividend snowball. So hopefully that was useful to you. If it was, give this video a like, aid in its distribution. Remember to subscribe for more high-value content like this. And if you want more detail on how I'm running my portfolio with live trade alerts, exclusive in-depth interviews with management teams, deep dive research reports, and a lot more, including a real-time chat where I'll respond to any of your questions. I also do phone calls with members to help them work out ideas for their own portfolio. Check out High Yield Investor. The link is in the video description. We'd love to see you over there. Thank you very much. See you next time.